This duck has one loaf of bread, and this bakery needs to borrow it. So the duck hands over its bread and receives a tiny piece of paper in return. Congratulations. The duck just bought a bond, which sounds much more exciting than professionally lending someone bread. A bond is basically an IOU. A government or company borrows money from you, promises to pay you a little extra along the way, and eventually gives your original money back. Hopefully, that last part is important. Imagine a bakery wants to expand. It needs new ovens, more tables, and, for some reason, a six-story bread fountain. But all of that costs money. So the bakery sells bonds to a group of ducks. Each duck lends it some bread to help fund the expansion. In exchange, the bakery promises two things. First, it will make regular interest payments. These payments are called coupons. Second, on a specific date, it will return the amount originally borrowed. That date is called the bond's maturity, so the duck gets small bread payments over time, then receives its original loaf back at the end. Bonds can be issued by governments or by companies. Government bonds are generally considered safer because governments are less likely to disappear overnight. Companies can be riskier. A giant, profitable bakery may be fairly reliable, but lending bread to a duck who launched his bakery yesterday from a cardboard box, that bond may offer more interest because there is a higher chance you never see your bread again. This is called credit risk, but you do not always have to keep a bond until maturity. You can sell it to another duck, and this is where bond prices get weird. Suppose your bond pays 3% interest. Then new bonds appear that pay 6%. Nobody wants to pay full price for your sad little 3% bond anymore, so its price falls. But if new bonds only pay 1%, your 3% bond suddenly looks fantastic, so its price rises. That means bond prices and interest rates usually move in opposite directions. When rates rise, existing bond prices fall. When rates fall, existing bond prices rise, like a seesaw, but with significantly more spreadsheets. So why would anyone buy bonds instead of stocks? Stocks give you ownership in a business. Bonds make you a lender to it. Stocks can offer more growth, but their prices can swing wildly. Bonds generally provide steadier payments and can make a portfolio less chaotic. They are not completely risk-free, but they can help balance investments when stocks are behaving like ducks who just discovered day trading. So a bond is simply a loan turned into an investment. You lend money to a government or company. They pay you interest, and at maturity, they return what they borrowed. Assuming everything goes according to plan, the duck is not the owner. It is the lender. And for once, someone owes the duck bread. Hope you enjoyed, and please subscribe for more finance explained with ducks. Every subscriber means one more slice of bread for the flock. Ducks get bread.